Title: Balancing Act. Navigating dividend yield and growth potential in stock investing. Introduction. In the intricate world of stock investing, investors often grapple with a fundamental question: how to strike the right balance between the steady income provided by dividends and the enticing promise of capital appreciation through growth. This dilemma unfolds in the interplay between a stock's dividend yield and its growth potential, two key factors that shape the investment landscape. To unravel this complex dynamic, we must delve into the significance of dividend yield and growth potential, exploring their nuanced roles and the delicate equilibrium they maintain for investors. Dividend yield unveiled. Dividend yield, a quintessential metric for income-oriented investors, is the annual dividend payment of a stock divided by its current market price. It serves as a percentage, offering insight into the income generated by an investment relative to its market value. Companies with a history of consistent and increasing dividend payments often attract income-focused investors seeking a reliable stream of cash flow. Consider a scenario where Company A boasts a dividend yield of 4%, while Company B's yield is a modest 1%. On the surface, Company A might seem more appealing to income investors due to its higher yield. However, assessing dividend yield in isolation can be misleading without considering the growth potential that accompanies it. Growth potential dynamics. Growth potential, on the other hand, encapsulates a company's ability to expand its revenue, earnings, and overall market value over time. Investors eyeing growth stocks seek capital appreciation, anticipating that the value of their investments will increase significantly. Companies reinvesting profits into research and development, new markets, or innovative products often attract growth-oriented investors willing to forego immediate income in favor of future gains. Imagine Company X, a technology firm, with a minimal dividend yield of 1% but a track record of double-digit revenue and earnings growth. On the flip side, Company Y, in a mature industry, offers a generous 5% dividend yield but with limited growth prospects. Investors now face a delicate decision: whether to prioritize the immediate income from Company Y or bet on the potential future gains of Company X. The dividend growth tension. Investors often find themselves entangled in the tension between dividends and growth. The allure of a high dividend yield can be irresistible, providing a steady income stream that is particularly appealing in volatile markets. However, an excessively high dividend payout might signal a lack of reinvestment in the business, potentially hindering the company's ability to innovate or expand. Conversely, growth stocks may appear tantalizing with their potential for substantial capital appreciation, but they often eschew immediate dividends. This can pose a challenge for income-focused investors who rely on regular payouts for their financial goals. Striking the right balance between dividend-paying stocks and growth stocks requires a nuanced understanding of individual financial objectives, risk tolerance, and time horizons. Total return perspective. To reconcile the dividend yield growth potential conundrum, investors often turn to the concept of total return. Total return incorporates both capital appreciation and dividend income, offering a comprehensive view of an investment's overall performance. While a high dividend yield can contribute significantly to total return, growth potential augments it by increasing the stock's market value over time. Consider an investor who purchases shares of Company Z with a moderate dividend yield and steady growth. Over the years, the investor benefits not only from the reliable income provided by dividends but also from the increasing value of the stock due to the company's sustained growth. This holistic approach allows investors to harness the dual engines of income and growth, optimizing their total return potential. Market conditions and investor preferences. The relative attractiveness of dividend yield and growth potential is not static and varies based on market conditions and investor preferences. In times of economic uncertainty, investors may flock to dividend-paying stocks for stability and income. However, during periods of economic expansion and optimism, growth stocks may shine as investors chase higher returns. Consider the market landscape during a recession where risk aversion is high. Dividend-paying stocks, traditionally viewed as defensive, may be in vogue, offering a reliable income stream even when the broader market faces headwinds. Conversely, in a bullish market, growth stocks may capture investors' attention as they seek to capitalize on the potential for robust capital appreciation. Diversification as a strategy. Recognizing the merits of both dividend yield and growth potential, many investors adopt a diversified approach. By combining dividend-paying stocks with growth-oriented investments, investors can construct portfolios that provide a balanced blend of income and capital appreciation. This strategy mitigates risk, ensuring that a portfolio remains resilient in various market conditions. Conclusion. In the intricate dance of stock investing, the interplay between dividend yield and growth potential is a central theme that investors must navigate. The decision to prioritize one over the other hinges on individual financial goals, risk tolerance, and market conditions. Whether seeking the reliability of steady income or the allure of future gains, investors can optimize their strategies by embracing the complementary nature of dividend-paying stocks and growth stocks. In this delicate equilibrium, investors find the key to unlocking a well-rounded and resilient investment portfolio, capable of weathering the complexities of the ever-evolving financial markets.